Afsaneh, for long-term investors, how do you shift? How do you recalibrate over the last 3 months and even trying to look 3 years forward?
Tom, a lot changed, obviously, in March, and the institutional investors, though, have not been behaving the same way we saw with the euphoric retail investors. Institutional investors have been looking sort of, as you said, behind the numbers that we've been seeing in the short term and being much more cautious, whether it was with the rebalancings between the last few months or looking forward into new opportunities. I think if you look at most portfolios, you'll see a little bit more cash still in institutional portfolios, but also looking potentially for some distressed opportunities and not jumping in those areas too fast. In terms of the big topics that institutional investors are looking at, which is sort of the 60-40 portfolio or the 70-30 portfolio of equities versus bonds, there's a lot of discussion going on whether you can get the returns you need in the bond markets, especially given what we continue to hear from the Fed.
Well, but Afsaneh, this is so important, and I'm going to ask you this, and it's something I would ask somebody doing market forecasting at any given firm, but I think from an institutional standpoint, it really matters. Is dividend growth the new yield?
You know, dividend yield, obviously, some people are thinking of it as the new yield. I don't think that way myself. But also, I think the very big topic, Tom, that we need to be looking at is the way markets are looking at dividends and returns and earnings has been a little bit over the top over the last few weeks. And I think when we look at potential earnings and the impact it might have on dividends, looking forward into 2021, I don't think that the earnings that the market had assumed are going to actually crystallize. And I think maybe that was the reason you started seeing the impact of Jay Powell's speech yesterday. He wasn't saying anything really new, but people started realizing that there is a connection between the economy and the markets, which they've been ignoring over the last month or so.
Afsaneh, you brought up the 60-40 split in the portfolio. I want to talk about the bond side of things. There are a lot of people asking the question what role Treasuries plays in a portfolio out 2020 through the next several years. They don't offer me the income they used to offer me, and they may not offer me that support in a risk-off environment. Afsaneh, how are you thinking about that issue at the moment?
You know, what you may need to do is actually look at hedging a part of your portfolio versus allocating 30 or 40% in the fixed income area, or finding other things to put in that category. You also see people actually gravitating more to equities, not because the earnings will be so high, but because on a relative basis, you will be doing better. And then within that, you've seen a reaction of some to increase allocations to emerging markets, even in the recent past. Commodities is another area people are looking at. While there are different views on inflation and forces that might push certain commodities up, as like food and energy, of course, is on a much slower track. I think investors are looking more and more towards where can they find yield. And certainly, as you said, fixed income is not going to be where they expected to get the returns that we have had, particularly in the last 5 or 6 years.
Afsaneh, there is a growing concern that the Fed's policies, while propping up markets, will curb innovation and investment going forward. And this is really the focus of your current firm and what you're looking for. How much are you seeing evidence of this, that the perpetuation of zombie companies that basically would have failed if it hadn't been for the Federal Reserve policies, that is leading to a crimping of innovation that you're seeing in real time?
So what is really interesting, Alyssa, is that at the same time as all the negative trends that you've been talking about have been going on, innovation actually has continued. We had some of the biggest flows to venture in the last year or two, and that has continued. So while we do have this issue in the more traditional economy of zombie companies, as you mentioned, and then the other side of it is the mega size of companies. So let's say we have close to 40% of our economy now is in the mega companies. Similarly, if you look globally, in China, for example, that number is more than 50%. You have that trend going on at the same time as a lot of new companies are getting born. And our portfolio had a lot in health, education, and clean energy, financial inclusion. And all of those were really in more innovative small companies that have actually done quite well over the last few months, especially.